Good morning. My name is James Neathery. I'm from Fort Worth, Texas. I live in a little town called Alvarado, Texas, 20 miles due south of Fort Worth. But I was born and raised in Fort Worth, and, I'm from Fort Worth. I have an office downtown Fort Worth and have an office downtown Alvarado, too. We moved to Alvarado about 10 years ago. It's really a part of my story that I'm not going to share today, but I'm 5 minutes away from my office where I live. So I have a 5-year-old daughter, have a 26-year-old son, a 21-year-old son. So I practiced on them. My wife is a better salesman than I am, so I have a 5-year-old daughter. And I say all that to say that I can drive home and have lunch anytime I want, 5 minutes away, okay? I want to thank David for the opportunity to speak here today at the Infinite Banking Think Tank Symposium. I think it's a great honor and a privilege, and I'm appreciative. And I would also, if you would help me, recognize David in appreciation for what he's done with Infinite Banking over the last few years in these events. So that's 2 attaboys and a way to go for David Stearns, right? Okay. I'd also, let me say this. I have a friend and mentor, Ray Poteet. All of y'all probably know him. He says often, James, cream rises to the top. It's a natural process. You don't have to do anything to the milk. I'm from Fort Worth. I've had dairy cows in my life. Of course I knew that. Y'all know that. I never applied it to our industry or our profession. And I say that today because out of 308,000 licensed life insurance agents, you are here. 200. So there's about 307,000 agents that are missing. I personally believe that they should be here in Birmingham because this is where the truth about finance, money, and banking and dividend-paying life insurance has emanated for 40 years. So I believe you are the cream of the crop. I'm appreciative that I get to share with you, and I think you're to be commended for taking the time out of your full schedules and your busy lives to be here and participate. So, now I'm also thankful. I'm a very thankful person, right? Okay. I'm also very appreciative that I get to share my story one more time. Because I do. I share it everywhere I go. I share it as often as I can. And I appreciate that. I'm a student of my faith, number one, my profession, economics, and history. And several years ago, while being a student of my profession, I was at a 2-day seminar, a conference. Good quality speakers from our industry sharing their best practices, their ideas, and their concepts. And I just want to do better for myself, my family, my clients, and their family. I believe in the unseen hand. I don't know who I'm going to help by being productive. Donahoe said he's a capitalist. I'm a capitalist. I can't help but make somebody profitable by practicing capitalism, and I don't even know them. So, I'm being a student. I purchased all the books at this conference at the end of the 2 days. I take them home, everything that they referenced. So I stacked these books up on my nightstand with the intention of reading them at the end of the day, in the evening. At the end of the day, after you've spent all day with numbers and concepts, you're going home, you're basically trading family time for more numbers and concepts. Not happy with that exchange, I would start without finishing a book. I started without finishing about 5 books. Now I'm feeling like an underachiever, right? Every night the books are stacked up. So I literally went through the stack to get the thinnest book in the stack, thumbed through it, 92 pages, big print, lots of illustration, and blank pages. And I thought, well, James, you can read that book. So, just to feel like I'm making progress. So I read the book that night. And look, I was angry. like many of you probably, the first time you read Nelson's book, Becoming Your Own Banker. You know, I'd been practicing 14 years in the life insurance industry, at least moderately successful, $1 million round table producer, you know, organizations, affiliations, some designations. I'm participating. I had never heard of this. I did not know you could do with life insurance what you can do with life insurance. And I was a life agent. I was disappointed in our profession. Okay, so I knew it was good. You know, I read the book. I'm like, man, this is good. It's really good. I may not be able to convey how good it is or exactly put my finger on it, but it's good, and I want to take some to my clients. So the next morning, I called the number on the back of the book. Lo and behold, Nelson Nash himself answered. I just wanted to order some books. We had a pleasant conversation that went and ended something like this. Boy, I hold these 10-hour seminars all across the country, and you need to get yourself to one. So I ordered the books, and then I looked online to see where he was going to be speaking. And I thought she was going to be here today. Teresa Dillatush was hosting Nelson 2 or 3 weeks later. So I called up. She graciously allowed me to attend. I registered. And I think everyone that hosts Nelson should allow other agents to attend. So I call. She allows me to attend. I went. I drove over there. I went as a student. I met Nelson. I listened to him. You know, I took notes. I don't know how many times I've heard him, but I have notes from every time I've heard him. I've learned something every time. We've hosted him, I don't know how many times in Fort Worth, Texas. I still take notes. Anyway, I listened. I paid attention. I took notes. I went home, and the first thing I did was begin the process of restructuring my life insurance. I have a lot of policies. I'm not going to, put them all up here, but I will show my clients if they want to see my policies. I'll show them. If they want to see my loan portfolio, I'll show them. I've made every mistake I think you could make. The first policy that I purchased was to be funded after issue, right? Go through the underwriting process, jump through all the hoops. It's in the office. It's on my life. There was a 60-day window to get it funded, and I zoomed right past that window. I'm getting a commission on this check. I don't want to write the check. It's my policy. I had to get the policy reissued. I mean, that's a human factor, right? So, okay, so then it gets issued, and I deliver it to myself, right? I have some credit card balances. I mean, I'm human. It wasn't crushing debt or anything. But I could have taken a loan sooner than what I did to recapture, that interest that was going away from me. I didn't. When I finally got around to it, I didn't have a loan repayment schedule. And then the first time I made a loan repayment schedule for myself, I promise I violated it. Now, I just want to say that I think I've made about every mistake. I hope I'm not going to make more mistakes, but, I probably will. But here's a point about dividend-paying life insurance structured this way. I can make a mistake, a tragic mistake, and I'm not going to break that because it is built correctly. So, now since that time, I came back, I restructured all my life insurance. Nelson Nash, has become a big part of my life. Infinite banking has changed my life. It's become a part of my practice, a large part of my practice. It's changed my clients' lives, and it's changed some of their family members, right? I believe that every case has a client, and every client has a story. So that was my story. I'm going to share with you today Mr. and Mrs. Smith's story with real numbers on a real timeline. Dave said, James, don't bring me a bunch of projections and illustrations. So I'm going to share today with you history from the time we met to where they are currently. I've titled this, Meeting the Client Where They're At. David kind of talked about it yesterday. He's a grammarian. Look, I'm married to an English major. I know you're not supposed to end a sentence in a preposition. I get it. But I'm from Texas, okay? So I'm fixing to share with y'all the story of Mr. and Mrs. Smith with real numbers, so David is happy. But I heard somebody mention it earlier. I use round numbers, okay? So I have for you real round numbers with Mr. and Mrs. Smith. And here's a conversation that we have very early on in our relationship. We'll have it more than once, a relationship with the client. You know, your wealth must reside somewhere. It needs a primary place of residence. Just like me, from Fort Worth, Texas, can go anywhere in the world, anywhere in the country to take advantage of any opportunity, whether it's business or personal, just like you. When the opportunity is over, the vacation is ended, I return home to Fort Worth, Texas, because that's my primary place of residence. Your wealth, my wealth, the client's wealth is no different. And they have never heard it framed in that reference. They've never even considered that. So, I'm not a coach, but yesterday that was awesome. I believe in blocking and tackling, you know, the basics. And this conversation, I use this, early on, like I said, and we talk about the types of places that your wealth can reside. I'm moving from left to right on this screen, and we look at income and estate taxable accounts, the CDs, the money markets, checking accounts, savings accounts. Then we move one to the right. We look at income tax deferred and estate taxable, the qualified retirement plans, the annuities, the real estate structures. Look, we have an in-depth conversation here one more time about taxes. Because just because they've heard or they've considered taxes a couple of times, they have not really considered the treatment of their money and their wealth as it goes through their life. So we have an in-depth conversation about taxes here. Would you rather pay taxes on the seed or the harvest? Would you rather pay taxes on a little or a lot? There are benefits to tax deferral. The older client, most of the time, hadn't even had the opportunity to take advantage of tax-free accounts, like the Roth account. So they have this money, 403Bs, traditional Roth IRAs, whatever, traditional IRAs. You know, the benefits of tax deferral, everybody's talked about it, everybody knows it. There's no question there's a benefit, but they don't really clearly understand they're deferring the tax calculation as well. And would you rather pay taxes in a known bracket or an unknown bracket? And I know that y'all have these conversations with your clients. I'm just saying this conversation helps me, it helps them to get on track and look at everything in a big picture kind of way, because I'm convinced, look, if you don't understand the concept, the details don't matter. But if you understand the concept, the details don't matter. So, come on, I'm supposed to be slow from Texas, right? This is completely conceptual. If I understand this concept, I don't care what the details are. Just make it where I don't break it if I make a mistake, because I'm apt to make a mistake, okay? So we have those conversations. We move one box to the right. We talk about income tax-free and estate tax-free accounts. My clients, they've never considered the possibility of life insurance as a primary place of residence for their wealth. The paradigm shift in thinking continues. You know, estate taxes, they may not be a big deal for the next couple of years. We'll give Congress a little more time. You know, that's a continuing problem. But so we talk about the Roth accounts. Like I said, the older clients may not have had the opportunity to participate in Roth accounts. And then we look to the far right, life insurance and trust, income and estate tax-free. I don't practice outside of my abilities. I have relationships with attorneys. If trusts are called for, no problem. But I assure you the attorney doesn't know the life insurance like I do. And he may not want to. But okay. The client begins to see their wealth should naturally be moving from left to right. And really, the more wealth they have, the faster it should move. However, everybody has a comfort level. You can only move from left to right, from tax deferred to tax free. That's consistent with your comfort level. You can only move as fast as you understand. And a point that I want to make today is everybody's timeline is different. You know, I do business in other states. I do webinars and over the internet and through the mail. I've got clients that I've never met. But it's not every day I get a phone call saying, yeah, I've got $50,000 a year that I want to put into a life insurance policy. Can you handle that? You know, there's a ton of people out here. And 90% of America, which y'all, I'm sure know, I don't know where the pointer is, hold their wealth in the first two boxes on the left. Tax deferred and taxable. The income and estate taxable accounts. So there's a ton of money out there. I want to talk about that in a minute. But they begin to see their wealth should be moving from left to right. They understand that going from left to right, going from tax deferred to tax free is a taxable event. They got to pay the toll taker. Uncle Sam wants his money. You know, Guido is going to get his money. So would you rather give it to him when you control it or whenever he dictates it? I don't want to be too harsh, but we talk about how there's no question you can increase your control, use, and liquidity, and we'll demonstrate that. They don't even know what that means when I tell them you can increase the control, use, and liquidity. I mean, they might have an inkling, have a little bit more liquidity. They think they control their money anyway until they start really looking at the types of accounts that they have. And they had really no idea the profits from the movement of money and wealth. Everybody's using their money but them. They've not been accustomed to using their money. This is a new concept to them. Of course, we can reduce and eliminate the risk. We can reduce the fees, and then we can get more than one use out of a dollar. I understand y'all have heard this before. They have not. They don't know what it means to get more than one use out of a dollar. And can you really? And yes, you absolutely can. Then we talk about how this is an educational process. You have to be willing, right? You got to be humble enough to you can't teach a man anything that already knows everything. So it's a learning process. It's an educational process. And it has a timeline. And it's not, I don't have to over-educate them. I don't have to beat them up. If they understand what they're doing, it's my opinion. If they understand, if they understand what's going on, they'll know what to do, EVA. I'm convinced with a little bit of research and education, the solutions are apparent. Okay. So now we're going to kind of look at the overview. This is where when I met Mr. and Mrs. Smith, it was actually in 2008, toward the end of 2008, in a retirement seminar that I regularly hold around Fort Worth, Texas. They had attended 2 or 3 times. When they actually became my client, he was a retired civil engineer at age 67. So he's 3.5 years away from his required minimum distributions. Mrs. Smith is a 65-year-old housewife, beautiful lady. They have 4 children, grown and gone, 8 grandchildren, a respectable income, primarily from pensions, Social Security, and then income from a variable annuity through the guaranteed withdrawal minimum benefit. Their major assets were variable annuities. They were titled as IRAs. The purpose of the accounts were for income, present income, and future income. They had lost, in the account that I'm going to focus on today, over 23% in value in 2008. In their overall portfolio, they lost over 35%. They had no life insurance other than the high-priced death benefit through the variable annuity, which they had no idea the dollar amount they were paying for that benefit. And it had an income rider on it as well. And, of course, the management fees and the sub-accounts. They had no life insurance outside of that death benefit. They had no plan. And their concerns were, of course, market losses. They'd just gone through 2008. March of 2009 wasn't looking, overly rosy. They were concerned, and they should have been. They didn't know what to do, and neither did their broker. Okay, I'm not going to pick on the broker. I'm going to pick on my industry because they've got it coming. This guy was doing exactly what he was trained to do. From the first market correction in 2001, he goes out there and gives them guarantees through a variable annuity. He gets paid well. And he believes the market's always going to be the solution. The market growth is going to compensate and overcome all this sin and bad planning. All right? So it's almost, it's really tragically comical, in my opinion. Okay? So, but I just want to point out that I don't want to pick on the broker. I am going to pick on the industry. He is doing exactly what he has been told to do. In the market meltdown of 08 and 07, his broker didn't call Mr. Smith and say, you need to go to cash, and we've got a problem. He didn't call him in March of 09 and say, oh, you've got a problem, you need to do something. You know, the client's paying the management fee. He's paying indirectly for the advice, right? He intuitively knew, Mr. Smith intuitively knew something was wrong. It's a problem when you lose 35% of your wealth. He takes it upon himself to call and reposition his assets or his funds from the sub-accounts in the market to the fixed accounts in the variable annuity. He did that. I mean, that's my point, that, you know, he's paying for the fees, he's taking all the risk, and he's not even getting the service. His banker didn't call him, his broker didn't call him, the life insurance guy, the life insurance guy called him. But, you know, the advisor didn't. They did it themselves. And as we go through this, you know, I'm going to talk about equity index universal life. I have something to say for it. I'm going to share. So, look, moving from left to right, you know, I met them where they were financially. And the first thing we did is we repositioned the variable annuity that had the 3% annual fees with the income rider. It was an okay income rider, but it had the death benefit and some survival benefits that they were paying for that would have eroded the death benefit if the spouse could have continued with a IRA spousal continuation. So here's my point. Mr. Smith had a death benefit. That death benefit would apply to Mrs. Smith if she'd have lived long enough and outlived Mr. Smith, but the benefits would have eroded each other. The death benefit would have went away through the income account rider if they'd have lived long enough. So it was okay. It wasn't that good. The first thing we did, we repositioned the $708,000 annuity into a fixed indexed annuity, and it had an income account rider as well. It was 0.75%, not 3%. They received a 5% bonus right up front, no smoke and mirrors. It was over $35,000. So they had a beginning account value of $744,000. All we did here was eliminate the risk, and then we reduced the fees. That income account rider also has some nursing home benefits on it, home health, assisted living, and nursing home. So we're getting more than one use out of a dollar. Hey. We go forward 12 months. Their account value is $777,000. Their income account value is $797,000. This account was positioned for future income. They, with the IRA, felt like they had put the money in for future income, and they were not going to touch that money because that was for their future income. And if they didn't use the money, then the remainder would go to their family, 4 children, 8 grandchildren. The point is, they're not using their money. They had no intentions of using their money. Of course, the broker comes and says, hey, what are y'all doing? You know, they've got a long-established relationship with this advisor. He says, look, don't leave, don't go. I can do that for you. The market's going to come back. You know, it'll come back. Look, it's a paper loss until you move, then it's a real loss, right? It's only a paper loss. The market will come back. You're in it for the long haul. How do you tell somebody age 67 you're in it for the long haul, the market will come back? How long is that? I don't know. But, you know, I've met with them several times. They stayed the course. They continued. They weren't leaving. Now, 6 months after the anniversary, we're 18 months later after they become a client, we make a withdrawal from the IRA, $40,000 in premium. It's a gross withdrawal, a gross premium. He's paying the taxes from the sidelines. Money he has available in cash. That's what he wanted to do. I agreed with him. It wasn't an issue. They purchase 2 life insurance policies. These premiums are combined, their cash values combined, and their death benefits combined. Okay? So we make a withdrawal. The $40,000 equals or turns into they had $22,500 in first year cash value and over $434,000 in combined death benefit. This was 18 months after they became the client. They had seen by now Nelson a couple of times. They had read Nelson's book. They now know more about life insurance than their agent or their broker, who comes around and says, hey, what are y'all doing? Well, we're buying life insurance. Oh, perfect. So he runs some beautiful illustrations, uses a $40,000 premium for the illustrations. And, of course, what's he going to run? He's been selling with stock companies. That's his solution. Variable annuities, fixed index annuities, whatever they may be, they were stock companies. So he brings them a nice illustration with equity index universal life. It says you're buying a whole life policy. Those have horrible returns. My equity index universal life policy is going to have greater returns. Again, he's doing exactly what he was trained to do. He believes the market is always going to rise and will cover all the sin. Well, my clients already knew about, I'm telling you, they've already read the book, they've already met Nelson, they understand what equity index universal life is. They have an equity index annuity. They're 2 different animals. There's an expense with the options for the risk, I get it, but there is no growing drag for death benefit on equity indexed annuities. That equity index universal life has a growing cost of insurance. And here they are at 67 and 68 years old, and this is still the industry's solution for them, is to buy equity index universal life. I digress. We go forward 6 months, so this is the second anniversary of the annuity account value. It is up to $771,000. Their income account value is $811,000. Forward 6 months, second premium on the life insurance policies, $40,000 gross withdrawal, taxes paid from the sideline, and it's premium directly into the 2 policies. Cash value increases, almost $40,000. And the death benefit increases a little over $40,000. Agent continues to come around. He says, listen, what are y'all doing? His illustrations look good. When you run an equity index universal life illustration in 2010, and they're looking good up till today. Right? But my clients understand, and he's starting to also learn as he comes around and not wanting to lose business, in essence. He's beginning to learn what they're doing and then what they're doing with their life insurance policies. This man's been in the industry over 40 years. He's getting an education through the clients. Okay, right up to March of last year, 2012. The income account value is $824,000. The actual account value is $740,000 in the annuity. September of last year, just a few months ago, we make the 3rd annual premium. Again, there's a correlating increase in cash value, so the premium directly goes to increase in cash value, plus there's an increase in death benefit. My clients do not care what the rate of return is. They understand that there's a loss of liquidity in the first year. They get it. They understand that they're paying taxes from the distribution, from the IRA, to make the premium. They were going to have to make those withdrawals anyway. They're going to pay taxes on that anyway. They understand the big picture, the concept of what they're doing. They're not stuck on, and they can be if they want to. I'm just saying this particular Mr. and Mrs. Smith, they're not stuck on rates. They've never had more control, more participation in their wealth. They're the ones actually controlling the movement of their wealth. They've been around 30, 40 years. Every time an agent or broker shows up, they want all their money to move. I got to beat that broker up, so I can sever that relationship, so you'll move all your money with me. They clearly see how the movement of money creates wealth. Most of the time, it's for other people. That paradigm shift has happened. They're not stuck on interest rates. They understand the volume of interest. Now, I must say here, they're young and healthy. right? She got issued preferred. I could care less. Half the time when they get issued preferred, I won't take it. It depends on the structure of the policy. But, it helped her. It didn't hurt her, so she was excited, and she was able to say, hi, look at me. I told you should quit eating all that stuff. Lose some weight, get your cholesterol levels down. My point is that they're participating in their wealth like they have never done that before. The life insurance policies here, there's 2 of them, 1 on each. They also have a long-term care rider or an extended care benefit rider. They don't want to go to the nursing home. She's issued preferred. She probably won't go to the nursing home. But we've increased their benefits. We're getting more than 1 use out of $1. They understand it's not meant to replace long-term care insurance. They understand that the rider on the annuity is not meant to replace long-term care insurance. But here they are. Hopefully they never have to use it. They have more long-term care coverage or benefits than they've ever had before. Just a side note. Here we are, right up to the present. Every one of those are not projections. Those numbers came off of the annual statement, not projections. Okay? March, next month. Look, if the market corrects and crashes, right, nothing's off the table, right? Their account value is going to be worth at least $700,000. A couple of $1,000s either side. If the market corrects horrendously. If the market just continues sideways, up a little, down a little, their account value next month is going to be $735,000. And they don't care. They're not worried about it. Their income account value, which was the primary purpose of this account, is $835,000 no matter what. The market goes up, the market goes down, the market goes sideways. They don't care. We're going to put it on there. We're interested to see it, but we're not penciling the returns every year. And they aren't either. Okay, so we're going to look at some of the results. I met them where they were financially. He's a civil engineer. He's accumulated all this wealth in qualified retirement plans. There was no way he was going to start liquidating every bit of that tomorrow and put it into an infinite banking policy. Now, she, on the other hand, was a little sharper than him. She was, all on board before 18 months. But I met them where they were. We tried to better their position where they were and then begin the education process. And if they participate in that, they're going to naturally move, in my opinion. That's been my experience. Uncle Sam's going to force them. He wants his money. They've got to take the distributions. It's got to go somewhere. And to speak on the industry, there's, 600,000 annuity agents out there that are being trained by stock companies to go and present this concept to their clients. The problem is the product they have is equity index universal life policy. The agent's doing it because he believes what the industry's telling him. He believes the market's going to make the returns. He's going to convey that belief to the client. And the ones that believe it are going to find out that that's not true when it's too late. 4 or 5 years from now, when the markets haven't returned and the growth in the equity index universal life is not big enough to support the increasing cost of life insurance, to support the cost of the options to hedge against the loss. The more volatile the market is, the higher the cost of the option. And then the net, after all those expenses, then we can expose it to an indice that isn't going to have the dividends credited, that has to participate in a rate, a cap, and a spread, or a combination of. The result of those is what earns interest. And it isn't going to benefit the client to find out 10 years later that he can't take the income that he thought he could. And here they look good. When the market's up and sideways, those equity index universal life policies look good. I'm not trying to beat up a product, but the industry got it wrong in the 80s with universal life. They got it wrong in the 90s with variable life. They've got it wrong with equity index universal life, and you shouldn't be a part of it. All right, so I digress again. We eliminated market risk. The extended, 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 we eliminated market risk. We reduced the fees from 3% to 0.75%. They had no idea that they were paying over $21,000 a year for a high-priced death benefit and a mediocre income account value. We reduced it to 3/4 over, $5,300. We've increased the estate to their heirs. We've increased the estate liquidity. We've increased their immediate liquidity right now, day one. And how can you do that with an annuity? Well, it had a greater free access amount. In year two, their liquidity is increased dramatically. Their wealth is moving from tax-deferred to tax-free, and they're in control of it. You know, the premiums on those life insurance policies can go way down. They can go way up. They've been built correctly. They're in control. If you think about this for a minute, the policies now that are coming on their 4th and their 5th year, they're maturing. In another 2, 3, or 4 years, the distribution from the IRA that's taxed is going to go directly into a maturing policy, and the increase in cash value that year is going to compensate for the taxes. And the longer they go, the greater that is. There's going to be an increase. It's the only way I know that that you can potentially profit by paying taxes from RMDs. There are other ways, but okay, we're using about 5 to 5.5% of the account value. The actual internal rate of return is higher than that. It's going to change, and they don't care. You know, one year it's going to be higher than the other. It's going to trend down because of the bonus. I get it. They get it. It's not a big deal. And then they're enjoying the use of their money, and we're going to look at that. And I've already made the point of 18 months of education before implementing the infinite banking concept. You know, they had eliminated debt. They had some small debt. It wasn't big. They could have eliminated it anyway, but now they're enjoying financing it. They're actually becoming their own banker. You know, they know how to process a loan. They'll either call Julie or one of the girls in my office, or they'll do it themselves. Mr. and Miss Smith, you know, they tend to call because they like that. But they know how to do it. They have financed small purchases, I believe, appliances and things like that. And here's a point, too. They financed a couple of vacations. You know, we all hear the horror stories in our clients' lives, right? All the bad. Well, when we meet, I'm like, look, I don't know what your future is going to be. I just know it's going to be good. You know, the policy, absolutely, it's wrong. The illustration is wrong the minute you print it. I don't know what it's going to look like, but I think it's going to be good. And I want to know about the good times, too. So I bring that up because I had a conversation with Mr. Smith several months ago. It was last year. It was in the evening, and I was calling him. I don't remember why, and he answered the phone. He said, "Oh, James, I seen it was you. I wanted to answer the phone." So we had a conversation about whatever it was, and they were outside. I'm like, "Where are y'all at?" And he told me, wound up, here he is 70, right? And she's now 67 or whatever. And they've been down a whitewater river rafting, you know. So I'm like, hey, bring pictures, you know. And it was an extended vacation. I just thought that was cool, and I like to hear about the good things too. They have financed some investments outside investments, you know, and some have been profitable and some have not. The ones that have not been profitable are not going to change the way he lives. It's not going to change their cash flows one iota. They're in control. You know, now in the, you know, where I live, probably where you live too, they found gas all underneath this country, right? Well, the Barnett Shale is right underneath where I live. So we've been hammered for the last 10 years, you know, hey, do you invest in gas? Hey, do you invest in oil? Well, you know, we're from Texas. Of course we do. Why are you calling me? Shut up. You know, I mean, I say that because, you know, your clients are getting bombarded with these phone calls. They have been. And now he knows how to value his money, his wealth. If he takes a loan from the insurance company, he knows he's paying the insurance company money in the form of interest. But he also knows he's a policy owner, and that's a mutual company, so he has an ownership position. So now if the outside investment can't return at least 4, 5, or 6, whatever he set, he's not moving his money. He's not going to take advantage of that investment. They've never been in that position before. You know, if he wants to charge himself 5 and the company charges 5, that's his business. If he wants to charge himself 10 and the company charges him 5, the guy calling him for an investment is going to have a hard time getting him to send his money. I mean, does that make sense? He's got a way to value his capital that he didn't have before. Now, I love this too. They're financing repairs on their children's residence. Remember, 4 kids, 8 grandkids. Okay, they have a real concern that their kids are not getting it. They're doing everything that they're supposed to do. They're leading by example. They've heard Nelson, like I said, by now they've heard Nelson 5 or 6 times. Their kids don't all live around the Fort Worth area, but their children have had the opportunity to come in and hear Nelson when he was in town. My office is 20 minutes away from Mr. and Mrs. Smith. When the kids from out of town do come in, we have a standing agreement because he's really concerned about a couple of his boys that I will go to the office and meet them when the boys, if they're available, right? So it's a standing agreement. The kids are not getting it. They're really concerned. However, one of the kids needed a complete remodel on their house. They were going to borrow the money to do the house. You know, Mr. Smith tells me, they won't read the book, James. I'm like, yep, okay. And then here's the same thing that we all hear. I'm getting a match from my employer on my 401k. Why would I pay such high insurance premiums for a death benefit? Why would I pay big life insurance premiums? And then why would I borrow money or pay interest on my own money? This is the feedback that he's getting from his kids, right? The ones that aren't getting it. Guess where the loan came from to remodel the kids' house? It's from their life insurance policies of Mr. and Mrs. Smith. So the kids aren't getting it. Well, I hope they get it. They're participating by default. And the next step where Mr. and Mrs. Smith are right now is they're purchasing life insurance policies on all 8 of the grandchildren. Now, you can't buy life insurance without a death benefit, right? We started with Mr. and Mrs. Smith. We're taking RMDs from a maturing, or putting them into a maturing policy, and then we laid the groundwork for an even distribution of age classes. You know, it's a process of time. When Mr. and Smith die, the ownership of these policies are going to transfer to their children, whom aren't getting it right now. But the benefit is going to be for them and their children, Mr. and Smith's grandchildren, Mr. and Mrs. Smith's grandchildren, and then they've got this big old honking death benefit when they graduate that has to go somewhere. And if the kids get it, that windfall is going to go into maturing policies on the grandchildren. They love this. They ask me often, James, why doesn't everybody do this? I'm like, I don't know. You know, like they don't know. You know, I do want to back up and say that, you know, the first time I read Nelson's book, you know, I took it and gave it away to several business owners that I respect and that are profitable. And they say the same thing every time after they've read it. If they give it a reading, a thorough reading, more than a cursory review, James, why can you really do this? Is it legal? And why haven't I ever heard of it? And then the fourth statement, you can date them by. Well, I wish I'd have heard this 10 years ago. Well, they're probably only 20 or 30 years old, right? I wish I'd have heard this 20 years ago. They're 30, 40, or 50. Well, 30, 40 or 50. I wish I'd have heard this 30 years ago. Well, they're 50, 60, and 70. I mean, to the person. So I think everybody should be doing this. I think your clients have a target on their back in the stock companies, not that it's about my profession. Licensed life insurance agents wanting to do good is being sicked on the unsuspecting American public with equity index universal life. And they're your clients. And I think y'all should do something about it. Because this is better, can be just as flexible and more powerful if you show them how to use it than equity index universal life. Okay. That's what I have, and thank you very much.